Hi, my name is Alexander Ulis, and today's screencast presentation will be focusing on adjusting journal entries. So let's start with the basics. What are adjusting journal entries? They are entries that are made in general journal to record revenues that have been earned and expenses that have been incurred. This occurs at the end of each accounting period after a trial balance has been prepared. You need to know that there are 5 types of adjusting entries: a deferred expense, an accrued expense, a deferred revenue, an accrued revenue, and a depreciation expense. A deferred expense is when a company pays the cash before it incurs the expense. In this scenario, to calculate the amount used up, the beginning inventory would be $200 plus the purchases, which is $350, minus the ending inventory, which is $120, leaving you with an amount of $430. Accrued expenses is when a company incurs expenses and pays for them later. In this scenario, to calculate interest, you get 1,500 times 6% times 6 months over 12, as most interest rates are calculated annually, getting you $450. You then add this to the 1,500, getting you $1,950. Deferred revenue is when a company receives cash before they earn the revenue. Therefore, in this scenario, you would debit unearned revenue $75 and credit service revenue $75. Accrued revenue is when a company provides a service before receiving cash. Therefore, in this scenario, AU Display would have to show that they would debit accounts receivable $500 and credit service revenue $500 as well. And finally, depreciation expense is when a company spreads out the cost of a non-current asset over the duration of its lifespan. So in this situation, you would debit depreciation expense $2,000 and credit accumulated depreciation $2,000 on printing machine. That's it for today, and thank you for listening.